All right, everybody. As always, give me a second. Let me make sure that we're streaming live on all the various platforms. I am super energized despite having to do this same-day trip to, to Austin, Texas yesterday and sleeping around 2 a.m. For those that are watching this live, please do me a favor. Please like, share, and spread the word as we're live here. We're going to be talking about Trump, talking about ag, talking about tariffs, and all kinds of interesting topics that are on everybody's minds here. If any of you want to engage during this roughly 50-minute conversation live, whether you're watching this on X, YouTube, LinkedIn, I can see your comments. I can see your posts. Let's make this as interactive as possible. So if you have a question, I'll bring it up. Let's, like I said, make this as back and forth as much as we can. This will be an edited podcast under Lead Lag Live on all of your favorite platforms, Apple, YouTube, and Spotify. And with all that said, my name is Michael Guyad, publisher of the Lead Lag Report. Join me for roughly 50 minutes is Mr. Sal Gilbertie himself. A lot that we're going to be talking about today. Sal, I know we do this all the time, but there are always new people watching for the first time. Introduce yourself to the audience. Who are you? What's your background? What have you done throughout your career? And what in the world is Tucrium?
Sure. I'm Sal Gilbertie, and I am CEO and trading. We operate ETFs, focused ETFs on New York Stock Exchange. And I have a commodities background for a very, very long time, 40 plus years. And so we talk about a lot of commodities, generally focus on ags and energy, but we can talk about whatever you want today, Michael. And Tucrium is just the name of an herb, it's hard to name a company. And my family grows herbs. I come from a family that grows herbs, and I thought Tucrium was a good name, and that's why we picked it. It's here. That's our name.
So I caught a glimpse on CNBC where the anchor was talking about lumber prices. And anybody that knows me knows I like to track lumber because of the link to housing. And lumber's been on fire very recently. And the reason that the lumber prices have been skyrocketing is being attributed to concerns around tariffs with what Trump did his first term. First of all, I'm curious on your perspective when it comes to all this talk around coming tariffs from the Trump administration. On the one hand, it seems like a lot of thought leaders are saying, you know what, this is a negotiating tactic. It's not going to be anywhere near as significant as people think. On the other hand, if everybody thinks it's a negotiating tactic, then he probably has to prove them wrong. What's your take on tariffs here?
I hope it's a negotiating tactic. I'm a big free markets guy. That said, we had, let's not forget, Trump was president for 4 years. We lived through all of this. So we kind of know, we have a roadmap that we can follow. And it was largely a negotiating tactic. That said, he implements. He negotiates hard. He is a very good negotiator. And while it's a tactic to get what he wants. And so I'm guessing there will be tariffs. I'm guessing they won't be nearly as comprehensive as people think. That said, I think some of the fears are justified, but largely in commodities, and especially with agricultural commodities, as we've spoken about before, Michael, the world needs everything it can produce in ags anyway. So lumber may be different. And weirdly, somehow I have it bookmarked and it pops up on my computer. You wrote a great article on sawmills years ago, and that darn thing keeps popping up on my computer once in a while. It's very interesting. But that's just an aside. Look if you take ags, the world consumes all the ags it grows every year. There's very little left over, and so tariffs just make trade flows change a bit in terms of their timing. So there are only two countries you can really buy soybeans in any quantity from. That's Brazil and the U.S. in that order. And when one runs out, you have to turn to the other one. You need all of both countries' beans. The world needs all of both countries' beans. So that's just one example where, tariffs will matter, but they'll matter in just the order in which things get sold. And so there'll be trading opportunities. You'll see price dips in the countries that are deeply affected by tariffs. For instance, soybeans. Remember, last time the Chinese retaliated with a tariff on or a tax on soybean imports from the U.S. And so if they do that, that just means Chinese buyers who need both Brazilian and U.S. soybeans, they'll buy from Brazil first. When Brazil runs out, they'll come to the U.S. So U.S. farmers will take a hit in the near term because prices will go down. You've got landlocked soybeans here for a while. And then China will buy what it needs, and the soybean situation will balance out. So that's how these tariffs largely work for commodities that are produced and used, all in the same year.
I think that's an interesting point around sort of getting caught in the middle with China sort of retaliating from that perspective. Outside of soybeans and Brazil in particular, are there certain commodities where there's more fragility in terms of tariffs impacting them because of where they're based out of, or because of that idea that they could be somewhat in the middle of China and the U.S.?
I there probably are. I mean, when you look at it's fascinating to go online and look at what we import from China. We import all kinds of things from China. And so there might be these little niche areas that get harmed really, really hard, like, nuts and fish imports and things like that. But, we tend to look at the really big commodities. You started this with lumber. If for whatever reason, and again, I think it'd be really tough for Trump to go back on his own North American free trade agreement that he did 4 years ago. And so I think that it's going to be pretty tough to impose really severe tariffs on either Mexico or Canada. I really see that any of his stance on anything that has to do with Mexico and Canada is simply positioning. I don't know that he's going to override his own agreement that he made 4 years ago. So, lumber may or may not be affected. Lumber imports from Canada are really, really important. We'll see. In terms of the niche markets from China and elsewhere, we'll just have to see and leave it to the experts in those markets. I know nothing about importing, nuts or fish from China.
There were a lot of big movements, obviously, once Trump was declared winner of the election, in equities, in bonds. I'm looking across the ag space. I don't really see that much big movements across corn, wheat, sugar. But is there any part of the ag space which maybe has underreacted in some way, shape, or form to policy shifts that are coming?
There may be, and that may have to do with biofuels and alternatives.
Yep.
And there are two schools of thought on this. So one is I think it's more mainstream that some of Trump's appointees are not real biofuels friendly. They're not that supportive of alternative energy sources and things like that. What I found, and again, we've had 4 years of a Trump presidency before, and under that time period, everything benefited. So when he rolls back regulations, when he rolls back the fear of regulations, when that gets mitigated in the marketplace, and producers, especially commodity producers, can be more unencumbered and more free, you have an explosion in production. You not only have production become more efficient, it becomes more cost efficient. So you get more produced at a lower price of most commodities, and that's a very, very big deal. I think that people underestimate how much all boats rose during the high Trump tide, okay, of the prior time he was president. And what happened there was everything rose. In fact, alternative sources of energy, solar, wind, all of the things that you would associate more with a non-Trump administration, those things benefited tremendously because everything benefited. When energy prices go down, everything benefits because the cost of production of everything goes down. So even if energy goes down and you say, oh, well, it's not as cost effective to put in, say, solar, that's just not true. What happens is the solar panels get cheaper to produce, things get cheaper to install. And a lot of the states are continuing with their incentives, with their tax incentives. And so I think that a Trump administration is going to be really, really good for all aspects of the commodity industry and all aspects of the energy industry, including renewals and alternatives, because they were before. We've had 4 years of Trump before, and everything thrives. So I think that's going to happen again.
What about those who would argue, he's coming in, and yes, there's a lot of excitement, but there's still maybe a lingering risk of recession just because of the uninversion on the yield curve end of things. I mean, at last I saw, typically if the yield curve uninversion is a signal of recession, the lag is like 3 to 6 months, which puts us pretty much into the Trump administration. Any thoughts on that? I mean, is there a possibility here that the excitement is just, that Trump's not more powerful than the business cycle?
Absolutely. I absolutely, that's my biggest concern here, is that people are just setting aside the fact there could be not necessarily an economic contraction, but a slowdown in growth. And that's a very big deal, given that, we're used to these, stock market goes up every day. If it doesn't go up, you buy it and you win the next day. I mean, but most of that is because of government spending. And yeah, we're going to have again, it's not a government agency, but this DOGE department, it's a recommendation. Those recommendations are coming out on our 250th birthday in 2026, July 4th. That's great. None of those can be implemented without legislative action. None of the recommendations can be implemented. And in my mind, with some of the proposals I've seen by Trump to strengthen certain parts of the government, certain aspects of the economy, which will require spending, I don't see how the Department of Government Efficiency can find enough cuts to offset the spending. I think we still remain in enormous deficits. I think you still have all of the fundamental structural problems of printing too much money, spending too much money, deficit spending. All that's going to come and bite us at some point. Now, we've been saying that for, it seems like decades, and nothing ever happens. But that doesn't mean you're not going to have a temporary blip. And you and I have been in markets a long time, Michael. Things don't just go straight up. They don't go up every day. They seem to, but there's going to be a time when that ends. And, Warren Buffett's sitting on a mountain of cash for a reason. He knows it's coming. When it comes, he'll swoop in. Other people will do the same. So I think all this cash that's on the sidelines, a lot of people view it as fodder for a bull market that never ends. Could be over the long term, but there's always rise and fall, rise and fall, rise and fall. And yeah, in this market, we take 3 steps forward and half a step back, but you still take a step or a half step back once in a while. And that will come. I'm with you. I think it comes probably early in the Trump presidency.
Let's talk about subsidies and if anything could change when it comes to the Trump administration and farmers, which are, an important part of his base as well, and maybe educate the audience a little bit as far as what is the government's role when it comes to providing subsidies to farmers. How does that impact production? Let's start kind of from the basics here.
Sure. And what makes ags unique and actually a pretty good tactical trade is that all agricultural production around the world is subsidized by every government. The last thing anybody wants is to have their population go hungry. That's how you get overthrown and lose power. They're very sensitive to that in China, obviously, because they lived through the Great Famine. In the United States, we are like everybody else. We support our farmers very heavily, and farmers get used to operating at cost of production. So that's one of the secrets to tactically trading or allocating to commodities, especially agricultural commodities. Agricultural commodities and farmers in particular will get used to trading at the cost of production. So corn, for instance, in its 17-year history post the Renewable Fuels Act, which reset prices on a macro level. In the 17-year history, corn, basically its break even statistically is right around $3.75 a bushel, give or take, at futures equivalent. So corn futures prices, if you see them between 350 and 4, you're probably at the average farmer's cost of production, and you had one 5-year stretch in the last 17 years. But the minute there's bad weather, you see prices explode higher because we run with thin inventories in ags. Corn, there's probably 3 to 4 months inventory left over at the end of each year. So if you have a bad year the next year, people tend to get really nervous. And you see, and prices in the last 17 years have doubled 3 times in corn from the level where they're at about now. Corn's at about $4.20 a bushel. If you look at corn between 350 and 4, that's a base. That's a 17-year base. It violates it very briefly if it goes below 350 and comes back. So, allocators and tactical traders who are willing to invest for a year or 2 or 3 or 5, but not invest, say, in gold, where gold's a set it and forget it. You buy it, the chart goes from left to right on a slight upward angle with a little bit of volatility. It's a wonderful trade. You don't have to look at it. That is not the case with corn. Just as an example, you buy corn when it's down around $4. Between 350 and 4, it's got extremely limited downside historically. And you've had, again, 3 times in the last 17 years where it doubled. It went over 1750 at 750 one time when it went to 8. And so, if you've got a part of your portfolio you can allocate to an asset that has really limited historical downside and 100% upside, you've got a really high alpha potential trade with something that doesn't correlate the S&P 500. So that's how ags work. Corn's the example. Ags work because they're heavily, heavily subsidized. And I think what people forget last time is when Trump put the tariffs in, and U.S. Soybean farmers suffered the most because U.S. soybeans, as I referred to earlier, they decline when you first hear news of a tariff or a tax because people will just come to the U.S. last. So a farmer knows that, all right, I'm not going to sell any beans for the next 6 months when I'm used to selling beans, every couple of months in some good quantities. That's going to hurt. The price of soybeans will go down. We gave farmers a lot of direct payments. I think actually when the math is done, and people can go look it up, but I believe I read somewhere that farmers actually received more payments, more aid payments during the last Trump administration than the actual dollars lost in terms of crop prices as they were affected by the tariffs and the retribution taxes put on by China. So farmers are really powerful. They're really necessary. Even if they weren't powerful, you got to subsidize your food. They're going to make sure farmers are taken care of. Every administration does. Trump's will be no different. So while he may talk a lot about subsidies or non-subsidies, he may talk a lot about really harsh tariffs, and we may get some again, tariffs and retribution or taxes and retribution placed against us from other countries who buy our agricultural products. In the end, the farmers are either going to be subsidized directly by the U.S. or sell their crops later in the cycle and maybe at slightly lower prices, which is what happened last time. But in the end, they come out net ahead. I think that the same thing will happen this time.
Is there any kind of
That was a
negative to
lot.
those? No, it's good. No, but is there any kind of negative to those subsidies? Meaning, does it change incentives in some way, shape, or form that negatively impact or positively impact prices?
I think subsidies always negatively impact prices. I think, if you're subsidizing a producer, the producer is going to produce. And farmers are unique in that people say, oh my goodness, what's going to happen to farmers? Guess what? Farmers lead a lifestyle. They live on their farm, and farming is what they do. They get up in the morning, and that's what they do. They don't have anything else to do. They're on the farm. And so no matter what the environment is, the farmer is going to get up and plant and harvest. They may choose which thing they plant and which thing they harvest based on prices. They do that. Okay. So you may see a slight change in the mix of what's planted and produced in the United States, but farming isn't going anywhere unless you buy the farm and put a house or a building or a parking lot on it. It's going to be a farm. It's going to grow stuff. That's how it works. That's what the farming life is all about. Get out there and do it every day. And that's what they'll do. So you'll see things different. So if the price of soybeans go down, and soybean balance sheet right now is really healthy. That of all the balance sheets of the big three, corn, soybeans, and wheat, soybean is the healthiest. You've got Brazil increasing their soybean production every year. The U.S. has a massive surplus this year, very, very high relative to historical levels. Argentina is going to have a good year. All their soybeans planted already with some good rain. So you're looking at really good metrics for soybean production and soybean supplies. Whereas corn, there's a lot of it, but it's not as loose as the soybean. And then wheat's the tightest of all the balance sheets. 4 of the last 5 calendar years, the world has consumed more wheat than it's grown. Now, nobody's panicking. Wheat price is manageable. There's plenty of wheat. Okay. We always say there's enough or it's plenty. You never run out of a commodity, not ever. You just, there's price rationing. So if the price gets too high and people can't buy it, and you end up with some, okay, or enough for those who can afford it. But prices go down and sideways when there's plenty. And right now there's plenty of everything, with wheat being the most tenuous balance sheet in terms of, it's an interesting thing. And we may move there now, but Russia and Ukraine, it's having a hard time. It's going to lose this war. Okay. There's no doubt about it. Ukraine's going to lose the war. Jake and I have said that to you over the years as we've done these events. Russia started the war with one of its top defense people basically saying, military people saying, the Ukrainians said they will fight until the last Ukrainian to defend their territories, in which case there will be no more Ukrainians. The Russians have a 3-to-1 advantage in people and manpower. They don't care how many of them die, and they're going to win the war. That's just how this works. Now, it'll probably get a negotiated settlement in the end, but Ukraine is not going to prevail. They're not going to get all their land back. That's just not going to happen. That said, okay, the stocks of grain in Ukraine, that level's falling every year. The amount of wheat planted, while it was remarkably high last year, it was surprisingly high, this year is going to be lower. The amount of wheat planted in Russia this year is lower. Russia, there was just an article in yesterday's Wall Street Journal about the amount of money they're offering to people to sign up for the army because they don't want to conscript 18-year-olds out of, the elites of St. Petersburg and Moscow because Putin will lose his support of the elites. So what they're doing is offering to pay people in the countryside enormous sums of money to sign up for the military, to fight in the military. And if they're killed, their families are paid a sum that apparently is, when you total all that up, it's worth more than the average 35-year-old farmer will make the rest of his career in Russia. And so, okay, those economics kind of work for people to go sign up if they don't mind the risk of dying. And if you get enough people from the countryside to sign up, Russia's agricultural output's going to fall. And that's a huge problem because Russia feeds the world. The only reason wheat is still very affordable right now is because Russia feeds the world. Russia has enough wheat to feed the world, even when Ukraine can't ship any out. Okay, so Russia's the world's largest wheat exporter. They're going to stay that way. But any blip in Russian production, and there are estimates already saying Russian production is going to decline very significantly next year because there's bad weather in Russia, poor planting, bad weather. You start taking the people who actually know how to grow wheat out of their houses and fields and put them in the Ukraine front. That's a huge problem, not just for Russia, but for the world. So wheat's the most tenuous of all the balances. There's plenty right now, don't get me wrong. But if you're looking to buy a dips in something in the ags, wheat's probably the one that fundamentally has the best picture. Corn's probably the one that's closest to its support level, where if you look at the last 17 years, I talk about that breakout trading range where corn's break even is between, call it $3.50 and $4 a bushel. It's got a wide trading range if you take out the spikes of $3 to $4.65. Okay, but it's spiked 3 times in the last 17 years to above $7.50 to $7.50 or higher. So if you look at the trading range really being $3.50 to $7.50, okay, corn at $4, you're in the bottom 15% of a trading range on an asset that doesn't correlate to the S&P 500. So if you're looking for an asset that has low correlation, it's always ags, okay, because they beat their own drum. The people still eat. They don't care what the stock market's doing or who's the president. They don't care. And so what really matters is you've got limited downside, but you've really got limited downside based upon the historic breakout range. The break-even range is call it $4, give or take. Okay, but the breakout range is up to $7.50 or $8. If you can buy corn at $4, you got downside to $3.50, maybe a hair lower. You got upside to $8. So there are a lot of people that will begin to allocate when corn hits that $4 level. We've seen it before; it'll happen again, and just put 1 or 2% of their portfolio as a stabilizer, because when it doubles, they get that 1% or 2% kicker, and they're heroes. And if it's just trading sideways, okay, it doesn't do anything to your portfolio. It's fine.
I know Jake likes to talk about technicals, and a lot of people look to technical support resistance when it comes to the ag side of things. You mentioned spot prices. Maybe explain for the audience how your ETFs are structured, because you're not tracking the spot, you're tracking the futures side of things.
Correct. We intentionally, when ETFs first came out, they were all spot, okay? And the famous ones were oil, okay? They just held spot futures. And when you have to roll, you can't take delivery of those futures. You roll, there's something called a roll yield, and it's generally negative if all else is equal in commodities. So you would lose. So we designed different funds where they bought non-spot, so second month and third month, and then an anchor month. So we hold 3 months. And that kind of mitigates that negative roll yield or positive roll yield. There's no way to predict whether it's negative or positive. So we just try to smooth it out. There's always an effect. And so we did it for these people who can tactically trade, who realize that ags, and I'll just stick with corn just because it's the easiest example. But if corn's sitting around $4, give or take, that's got really low downside relative to history and significant upside relative to history. So if you're looking to diversify your portfolio, just hold ags. That's the time you want to put in your portfolio. As a diversifier, you can buy corn when it's at $8, but you're gonna take some drag on your portfolio because of that, some negative drag at some point when corn returns back to its cost of production, which all commodities do. So what you want to do is tactically allocate, which means, again, you're going to hold from 1 to 6 years. In the past 17 years, you had to wait 1 year for the price of corn to double, one time 2 years for the price of corn to double, and one time 5 years price of corn to double. So when we look at those patterns have always been the same, just at different break-even numbers throughout the decades. We looked at those and designed these funds so that people could tactically hold them and have the potential negative effects of roll yield mitigated a little bit while they held on to these things, waiting for that tactical double.
Are there of the different products that you have, are there some certain ones that have less, risk of significant roll yields, where it's the contango backwardation is not that dramatic, that it's closer to spot?
I'm going to say no. That said, statistically, Bloomberg is always, Mike McGlone over at Bloomberg is always running articles on our soybean fund that it is the closest tracking to spot. These funds are not designed to track spot. They're designed to move up when the commodity moves up and down when the commodity moves down, but not to track spot. Now they will, okay? They just won't have a 0.99 or 0.95 correlation. It'll be lower than that, but to spot, I mean. But our soybean fund tends to do the best with that statistically. I don't know why. And they weren't designed to track spot. So, they are what they are. They go up when the commodity goes up and down when the commodity goes down.
Let's talk about how China factors into all this. We talked a little bit about kind of the tit for tat that can happen as far as China retaliation, but let's play it out. I mean, there's stimulus that's apparently coming in China. The markets are not really that excited about it in China, at least not yet. They were momentarily and then kind of tailed off. What are the implications on various ag plays on China's growth reaccelerating?
Ag's a different category in that so long as China has the world's largest hog herd, which they do, they have the largest swine herd, they consume more pork per capita than any other population, and they are the second highest population in the world. So they import a lot of soybeans because of that. China's got an interesting history. Their people and their economy, their population, their economy grows, and they need more stuff than they can produce. So when they started importing oil, they didn't look back. When they started importing soybeans, they didn't look back, meaning every year they import a little bit more over time. Okay, the trend is up and to the right. When they started importing wheat, which was just a few years ago, they haven't looked back. They're importing wheat. So they need more and more and more agricultural products. If their economy can stabilize and grow, they're going to need to import more because they really lack. They don't have more arable land to expand like Brazil does. They really lack good water. Even in some spots where there is land, they don't have adequate water supplies to grow. And so China's always going to be an importer. And the interesting thing about China is when they start importing something, it just grows. They never stop. Now, I think that Chinese economy is going to affect copper more than anything else. I think that the Chinese economy has affected copper. That's why it's come off of its highs and been in this downtrend to sideways trend for quite some time. That happened with the Chinese contraction. Okay. But if they can stabilize their economy and start going back up, obviously the need for copper is going to go up. I think the global need for copper is going to go up. I think Goldman Sachs is exactly right. There are going to be global deficits in terms of production versus consumption for as far as you can see into the future, because it takes so long to bring a copper mine online. And let's face it, the everybody thinks about China and all those buildings being built and all property, but the bottom line is everybody's building out the electrical grid now. Everybody's expanding their economies in tech. And AI and everything that's related to it and everything you can build around that, which is explode your whole economy, but reliant on power. And so I think the future for everything, well, it's always ags, okay, and always energy in terms of oil and natural gas and coal, and alternatives, which are electricity, okay, and you need more electricity. And whether you are producing electricity traditionally through oil, gas, and coal, or through wind or solar, or nukes, you still need wiring. You still need all those components. So China is going to lead the world again in copper use, probably, or lead the copper markets up or down in terms of their economy. And I think that people need to pay more and more attention about the green metals, most of which the green and critical metals come from China. China's got a lock on those things. One of the things I see as a growth area, and I'm not a stock trader, Michael, this is more your forte, but I think that any green metals or the metals for your cell phones and things like that, I think any company that's going to start mining for those domestically here in the U.S. or in more friendly countries that are viewed more friendly than China, I think those companies are going to grow and be really supported in the new economy, no matter who's president, and really supported because Trump's president. I think there's a big future there.
I know we've talked about this before, but I think it's important to kind of keep hitting this point about asset allocation when it comes to the ag space. If you're a trader, you're a trader, right? I mean, we know retail loves to just YOLO into things, and maybe somebody's got some high conviction on soybeans or corn or other ag plays. But for allocators that are saying, you know what, you're probably due for a broader tailwind around the ag space. What do you find other advisors typically do in terms of percentages? How do they think about pairing it against stocks, bonds?
So for the advisors that are open to it, and again, people are being so successful, just buy anything and you make money in the stock market. I think that the people who are open to diversification, they naturally look at commodities. They've always thought about gold, which is unique. Again, it's a set it and forget it trade. And I think that they look at energy, and when they look a little further, they always see ags. They come to ags and they realize, wow, this is a pretty unique story. And for allocators, the big ags trading at their cost of any commodity trading its cost of production, but ags in particular, because they explode higher due to weather events. I mean, okay, we had the war, which doubled at once, but in the last 100 years, it's always a weather event that moves prices. And so there will be more volatile weather. We've seen that. We cannot afford, especially in the wheat markets, to have any large producer who's also an exporter, okay, get hit by bad weather. And you never know when that's coming. And history shows us it does come. It's only a matter of time. And so I think most of the people we're looking at, again, I referenced that 1% to 2%. I was specific to corn and grains. A lot of people are looking at 5 to 10 to even 15% of their portfolio in commodities of some sort. They generally start with a broad basket or with gold. But I think when you drill down, it's pretty obvious to see that grains on a tactical allocation, because they just return to their cost of production and trade sideways for a while until there's a hit again. And meaning demand is always rising. Okay. It's worth stating. We say it every time I'm with you, but the global combined demand for corn, soybeans, and wheat since 1960, every year is either a record or the second highest. Every single year since 1960, without fail. So your use is always rising. When there's a blip in your production, people panic, and that's when you see those price doubles. So it's a really opportune time when ags get down to that cost of production. And you can just see it with their sideways trading. Okay, you can see it on a chart. That's when okay, I've seen this ag, say corn, trading here before. It's down under 450. It's pushing 4. It may dip below 4, which we did several weeks ago, just for a week or so, and then went right back up. This is an area where I know I have limited downside. I know that this thing doesn't really correlate very well with the S&P 500 at all. I really want diversification. And I'm going to allocate here. This is a really liquid asset. I mean, corn, you can put as much money as you want into the corn, soybean, wheat, or even sugar markets, and you're not going to move that market. These markets trade decabillions a day in notional value. They're enormous. As with any ETF, when people are buying these things using ETFs, if they happen to do that, your ETF is as liquid as its underlying. It's the volume of the ETF is meaningless, as you know, Michael. We've had $50 million come into some of our funds in a single ticket and not move the spread by a penny. The spread's a penny wide, it stays there. And the thing at an average daily trading volume of 2,000 shares a day. It just doesn't matter because the underlyings are so liquid. So you have a highly liquid asset that is a really well-defined base, so cost of production base, and really significant upside, all that based upon the last 17 years of history. That's when people allocate. And we find people who do it, they tend to put 1 or 2% strictly into the ags.
Does it make sense to consider doing each of the various ag products one by one, or just do sort of a basket approach? I know you have a fund that basically has multiple ones in one wrapper.
Yeah, and the basket funds are the ones where the 50 million chunks come in and out of. Those are the ones that, and because people tend to like those. A lot of people say, look, I get it. I can follow corn, but corn and soybeans share acres, so I know they're correlated. Wheat's wheat. I really want to be long wheat, when it's down low. So I just want a basket. I don't want to pay attention. I want to put 1% in, and I'm going to keep it at 1%. When I rebalance monthly, and when it's 2%, I'm selling the whole thing. That's a pretty simple scenario that we do have advisors that tell us they do that. So it's your personal choice. I mean, we have a lot of people in the Midwest who follow corn, and they'll buy corn. We have a lot of people who, we had somebody yesterday call us, and they're really enamored with our wheat fund, buying wheat. Everybody's got the thing that they like. I think corn is the big one, and it has the biggest patterns. And so, and we keep updated charts on our website for people to see. But most people, honestly, the big aggregators who come in and out, and right now they're out because the ags have been on their way down from their highs of a couple of years ago. They come in with the 5, 10, and 50 million tickets. They generally tend to come into the multi-commodity products we have, the multi-fund products.
Let's say somebody really wants to kind of learn about the ins and outs, right, of the ag space. I know at Two Green you've got a lot of content. But this is like kind of, you can argue maybe a little bit niche for most people, even though it really shouldn't be. And you can't necessarily apply fundamental analysis in the same way. To your point, it's about supply demand imbalances. But how does one even go about self-educating on the space?
It's really hard, because that's kind of the reason why our website's so good, and people can go there anytime, twogreen.com. And they can contact us directly. It's what we do. We're here to help people. What happens is, what we found, and I found through my career, the people who really know about ags, they either write a paid newsletter, they work for a trading company, or they work for a hedge fund, or they work for a big ag trading company. They work for a hedge fund. They're not sharing that knowledge. They're making money off of their unique knowledge. So Two Green, I think, stands really alone in its public dissemination of the fundamentals of the ag industry as we see them, for anybody to use, because everybody else is for pay. They're making money on it. It is a niche industry, even though it shouldn't be. I mean, people say trade what you know, and everybody, for whatever reason, when they're in commodities, they trade gold and oil. Well, they say, well, I know I drive my car to work. I know I'm using energy. I turn my thermostat up and down winter, summer. Okay, but did you eat 3 meals today or 2 meals? Like you're concerned about your health and fasting. You're thinking about food all the time. Why don't you have food in your portfolio? It makes no sense to me that people don't have ags as a major component, especially when they're so, historically speaking, the whole deal, past performance is not indicative of future results. But historically speaking, ags are amazingly cyclical. You can see them go to their cost of production, sit there for a while, and then skyrocket higher, and then return back to their cost of production. You can see it happen over and over and over again. If you say to most investors, there's a repeatable pattern where something is trading at X, and every couple of years it goes to go back to the original X, any reasonable investor or allocator is going to say, well, next time it's at X, I'm going to throw an allocation into there. People need to start thinking about ags that way. They buy gold when gold, in the old days, when gold was under 1,500, 1,800 an ounce, people poured into it. We did a study when oil went under 50. One of the oil ETFs took in 3.3 billion. Okay. Well, corn under 4 is the same as crude oil under 40. It's the exact same thing. People are willing to buy crude oil under 40, stick it in their portfolio at some weighting, and wait for it to go to 80 or 100. They're willing to do that. They should be willing to do the same thing with ags, which are probably just as predictable, if not more predictable pattern, based on history than oil. Oil's got a lot of things tugging at it. Ags are very simply supply and demand. Geopolitics, even though there's tariffs and once in a while a war, geopolitics are literally secondary to supply and demand in ags. They always are. And so ags down at cost of break even, it's a repeatable allocation. It's been repeatable before. You can do it again. It's transparent now that there are ETFs, and it is really, really liquid. So I do think it should be an asset category everybody looks at standardly. They just should.
That I completely agree with. Sal, for those who want to track more of your thoughts in particular, because I know you also do several writings and contributions unrelated to ag in other places, where would you point them to?
Sure. Well, first off, twoCream.com. Then we've got our Twitter feed, twocreametfs.com. My Twitter feed is Gilbertie Sal, and their X feed. And I occasionally blog for Forbes. I've got to get back to that. We've been really busy. I do want to have time, but I blog on general commodities for Forbes as well sometimes.
Always enjoy listening to Sal. Everybody, please make sure you follow Sal Gilbertie. This was a sponsored conversation. Two Cream's one of my clients. A big fan of what they're doing, and I do happen to myself agree that I think it's probably an interesting time to consider the space actively. So with all that said, again, appreciate those that watch this. Please spread the word and learn more at the Two Cream website. Thank you, Sal. Appreciate it.
Thank you, Michael. Always fun.
Cheers, everybody.
Be well.